Guys, I think let's start off with this. So, the class that we are having today, or the entire course, let me give you a briefer about what it is and how are you going to benefit, or how can you take the best advantage of this course. Okay. The first thing
Okay.
is that it is a revision course. So the entire CFA level 1 syllabus that is there, we are going to, or we plan to revise in 50 hours roughly. So it may be 40 to 50 hours. That is the range that we plan to. And secondly, by mid of Jan or maximum third week of Jan, we are trying to, or we are aiming to finish the entire course. What we will do in this is that we will be covering each and every, or I would say each and every important portion, rather each and every portion of CFA level 1 curriculum. I will introduce you each and everything. Uh, and the best advantage that you can take from this course is that you can, suppose we will be having weekend classes. So on weekend, whatever topics we cover, if you can read or if you can solve questions related to those same topics during the weekdays by taking out time from your schedule, then I think that would be the maximum benefit that you can avail. So basically, what will happen is that if you continuously keep on following up with things, then you will be able to complete the entire course, or you will be able to touch base on each and every reading of the entire course within just 1 month. So this is the objective of the course. If you guys want to maximize the benefit, then you guys can everyone go on mute and only unmute when you want to say, so that there is no disturbances.
Okay.
Yeah. Okay. So what I was saying is that in this manner, we will be able to maximize our benefit of the entire course. Okay. Within 1 month, covering each and everything, actually, such a big syllabus is actually a challenge for anyone. But with the right guidance or with the right pattern, if we follow, then I think you will be able to maximize the benefit. So 1 month of dedication and the CFA level 1, you can nail the CFA exam. So that is what I would say. Okay. So this is the objective of the entire course. Let's begin with the content part today. I personally, whenever I teach in my class itself, I never go in a chronological order or study session wise, because that subject wise. So like when we stick to a particular subject, that is not the way to study CFA. Although institute has divided it in 10 different subjects, but I have always repeatedly said to my students in my classes that it is one knowledge, that is finance. Although they have divided into different subjects, you should not see it as different subjects. From exam perspective, obviously you would say, sir, there are like these things, like you have to pass all the different subjects. But yes, if you compile, or if you see, or when you will end the entire CFA level 1 curriculum, you will get to know that each and every portion is linked to the other portion. And that is why what we are going to do is we will be doing it in the most logical manner. We will be moving study session wise in our course itself, as I do in my master classes also, that we move study session wise. Today we will start off with study session 2, which is the very basic of the CFA, which a student must know, because there we get to know some of the basic things about interest rate, about usage of calculator, about the things that keeps on repeatedly coming up or getting applied in the entire curriculum. Okay, so let's start off with that. I'm sharing my screen. Guys, are you able to see my screen?
Yeah.
Okay, great. So guys, the first topic that we are starting off with today is time value of money. In time value of money, the entire reading, I have divided it into 4 parts. The first part is understanding interest rate, frequency of compounding, types of yield, and amortization. Okay. Now, moving ahead, first thing is, what is interest rate? So interest rate, they have defined interest rate in different ways. The first and the simplest way to understand interest rate is that interest rate comprises of four components. So firstly, the difference between nominal and real you must understand. Nominal interest rate, and whenever a word in entire CFA curriculum, whenever a word nominal comes into picture, it includes inflation. And whenever the word real comes into picture, it excludes inflation. Be clear with that. Okay. So just a second. As you can see over here, the word real, it means it excludes inflation, and the word nominal means it includes the inflation thing. Okay, so be clear on that. There is no exception to this rule. What they say is that interest rate is comprised of nominal plus default risk premium, liquidity risk premium, and maturity risk premium. Now what all these things are, you must be thinking. So let's come to the second part of it. Yeah. So RRFR, just a second. RRFR means real risk-free rate of return. What is real risk-free rate of return? These are basics. You should be very clear with this. So I will take a bit more time here, and then we will move on a bit quicker. RRFR, real risk-free rate of return. If I say you that you have $10 today or $100 today, okay, and you are given two options, what you can do with money. The question arises is what you can do with money. There are only two things that can be done with money. Number one is you can either consume it. Number two is you can either save it. There is no third option for even Bill Gates or Warren Buffett as well. Either they can consume today or either you can save money today. Okay. RRFR says that if there is no interest in this world, let's assume that the world where there is no interest rate, in that situation, what do you think what will happen? There will be no nobody will save in this world. There will be no incentive to save. Everybody would like to consume. The consumption foregone, you are foregoing a consumption to earn a rate of return, and that is the real risk-free rate of return. As it clearly states that what amount or what single amount that an investor or you would require to get the current, to give up the current consumption. You had that $100, right? You could have gone to a shopping mall. You would have shopped for it. You could have gone to a movie theater. You could have watched a movie. You could have enjoyed that money. But when you are investing somewhere, you are foregoing that enjoyment. You would be definitely wanting something in return, right? That is called real risk-free rate of return, RRFR. Next is IRP, which is inflation risk premium. After 1 year, what do you think? Inflation exists or it doesn't exist? The question is whether inflation exists in an economy or it doesn't exist in an economy. It do exist, right? Guys, be a
Right,
bit more
right.
interactive. Yeah, it exists, right? So in
Some
that
countries
case,
have inflation, yeah.
yeah. So now the question is that if you had to purchase something, anything, suppose an iPhone, you wanted to purchase an iPhone, and the cost of that iPhone is, let's assume, I'm taking hypothetical example, $100. Everybody would have wished it would have been $100, but actually, so it is not. But let's assume the cost of the iPhone is $100. Okay. After 1 year,
Okay.
what do you think the cost of that same phone will be? Will it be same as 100 or it will be bit more? It is expected to be a bit more. That is, let's assume
Right.
$110, $120, whatever that may be. But the point is that this extra $10 that you are paying after 1 year, the extra amount, what would have happened if you would not have invested your money? You could have purchased that same phone using this $100 itself. But after 1 year, when you go, you will have to pay extra $10. Don't you want that compensation? Your loss of purchasing power, you have lost your purchasing power within the time frame. After 1 year, you have actually lost something, your purchasing power. So you would like to be compensated for that. The third is default risk premium, which is DRP. So what are we doing over here? Just a second. We are learning what interest rate is, number one, and what does interest rate comprise of. Suppose you go to a bank and you see that if I want to do a deposit for 1 year, the rate is 6%. There must be some logic behind that 6%, right? Or is it an arbitrary number? It cannot be an arbiter. A bank, such a big institution, do you think it will work on an arbitrary basis? Okay, let's do one thing. Let's put a rate of 6%. Does it work that way? Or there must be any logical understanding of why this is 6%? Why is it not 5%? Why is it not 4%? Why is it not 7%? And why only it is 6%? The question that should be there in your mind, and you are getting an answer now. You must have gone to bank in your life, right? You must have seen interest rates, saving rates, deposit rates, time deposit rates, etc., etc. But why that particular rate prevails? Why not any other rate? The answer you are getting over here, that rate comprise of various things. One is real risk-free rate, the other is IRP, third one is DRP, that is default risk premium. Now, what is default risk premium? When you lend, my question is, if Vasudha, if I ask you to lend a bank, I mean to deposit money with a bank or to deposit money with a private company, which one will you prefer?
With the bank,
Why?
it's
More safe.
safe.
Definitely, it's more safe.
The
Definitely
security.
correct.
Yeah.
And if the private company wants you to invest with them, how can they do that, or what incentive they will have to offer you so that you make up your mind to invest money in there? They will have to offer higher rate. Like if bank is offering 4% of return, the private company will have to offer a higher rate, that is 6%, 7% of return.
Sure.
Definitely.
Higher than 6%, yeah.
Yeah,
And
a
more
high,
offers maybe.
yeah, a higher rate
Shares,
of return. A higher rate of return. That why are they offering this higher rate of return, or why did you said that you will want to invest with a bank? Because it is more safe. The other way round is the private company has higher probability of default,
of risk.
of
Of
risk.
risk.
Yes, and that same risk is being reflected here in form of default. That there is a probability that the private company may default, right? But the bank has lower probability of default. Suppose moving ahead, if you have a private company, or you have a second option to give it to a individual person. Individual person is asking for a loan, and a private company, let's assume private company Apple is asking for a loan, and an individual person in your neighborhood is asking for a loan. Which person is more safe?
Private company.
Private
company like Apple.
Apple is more safe. Then in that same situation, will if Apple is offering you an 8% rate of return, then the private person or the neighbor person in neighbor, if he offers the same rate of return, that is 8%, will you invest money with that person?
No, the Apple, because it has a high market share as a global wise, so Apple is more safe.
Definitely. In that means that person has to offer you either 10% or 11% or something higher than 8%. Then only you will be making up your mind to invest money there.
No, the 8% of Apple, so it's more safe.
Yeah, I mean that is more safe. But yeah, what I'm trying to say is that private person, if he wants you to invest, that person will have to give you something extra, some more incentive. Then only you will be enticed to. If he offers the same rate of return, then definitely you are not going to invest. That is for sure. With that private person, this difference is because of default risk premium. When you give your money to someone, the first thing that you will see is that whether that money will come back or not. Whether that money, if a bank also, when they lend, the first thing that bank sees is that whether the money will come back to me or it will not come back to me. That is the first thing. This is called default risk premium, and definitely it also forms part of interest rate. The third is liquidity risk premium.
Default risk premium, it's called?
It's called default risk premium.
Okay.
Yeah. Third thing is liquidity risk premium. Now, what do you mean by liquidity risk premium? Which one is more liquid? My question is, I'm naming asset class. You guys have to recognize which one is more liquid. Stock or real estate? Which one is easy to sell? Which one is more liquid? A share basically in a company which is listed on a stock exchange, or a real estate, a property?
I think a share, because it's a market, a daily market. Sure. So it's more fast to buy it or to sell it.
Definitely. It's much easy to sell a stock, I mean a share, but it is much more difficult to sell a real estate. Yeah.
Real estate?
Real estate is less liquid, right?
Oh, okay.
A real estate is less liquid compared to a stock. Why so? Because a stock is much more difficult to easy to sell, but a real estate you will have to find an exact buyer who wants the same property with that same location, with that same size and same dynamics. What they say is that if your investment, what type of instrument you are investing, this will also be a very important consideration when you ask for interest rate. If the instrument is easy to convert it into cash, see, the liquidity, the most liquid thing in the world is cash. You would agree.
Okay.
The cash that is lying in your pocket is the most liquid thing in the world, because you can instantly go to the market, use that cash and buy anything you want. Correct? If you deposit, even if you deposit it in your bank, then also it is liquid, but comparatively cash is more liquid. So liquidity concept always runs around this cash thing. Anything that can be converted into cash with minimum loss of time, remember, with minimum loss of time and with minimum loss of value, with minimum loss of time and with minimum loss of value, means as quickly as possible and as close to at the market price as possible, is called liquidity risk premium. Okay, so if the asset is illiquid, you will charge liquidity risk premium. If the asset is liquid, you will relatively not charge or charge a lower liquidity risk premium. The last is maturity risk premium. Maturity risk premium. Karishma, if I ask you,
yes,
what are you going to do tomorrow? And relatively, what are you planning to do after 1 month? Which one will you will be more certain or sure with when you are answering?
what I'm going to do tomorrow.
Right? And relatively, after 1 month or after 1 year?
1 month.
After 1 year or after 5 years?
1 year.
Definitely. Why? As the time period increases, the uncertainty increases. Correct? If I ask you money for 1 day and if I ask you money for 1 year, which one you will be more comfortable with?
1 day.
1 day, because you know that tomorrow I will be getting back the money, right? But after 1 year, what is going to happen? Can anybody confirm? Especially after this COVID thing, nobody knew that world is going to go for a toss, but it actually went. So uncertainty.
So I'm certain of getting my money.
Exactly. As the time period, so as they say, longer the maturity of investment, higher is the uncertainty. Correct? And with higher uncertainty, the maturity risk premium also increases. So all these components, 1, 2, 3, 4, 5, all these components form part of interest rate as is suggested. So interest rate formula, as you can see in your institute mat also, this same formula is there. The formula comprises of real risk-free rate of return plus inflation risk premium plus default risk premium plus liquidity risk premium plus maturity risk premium. This is where this 6% is coming from. So if you go to market now, if you go to your bank now and you see the bank is offering a rate of return of 6%, 5%, 4%, you should not be confused. This 4%, this rate comprised of all the 5 components. All the 5 components. Okay, and this is what make up the interest rate. Are we clear? Interest is the cost of money. Now, what is interest? Interest is the cost of money. It can be viewed in 3 different ways. Entire CFA curriculum, either you will view it in A, B, or C. Okay, number one as required rate of return. Required, you are investing your money. You must have some expectation in your mind, isn't it? That I will earn a rate of return of this much or this much or this much. When you are investing your money, you would be definitely wanting some rate of return. Otherwise, why will you invest? That is called required rate of return. The next way of looking at the same interest rate is as discount rate. Discount rate means what the future cash flow, how can we calculate future cash flow, or how much cash flow if I invest today, that amount will grow up to in future. That is called discount rate. The third way to look at the same thing is opportunity cost. Opportunity cost means next best alternative. If you had two choices, save or consume, what will you do basically? If you are saving, definitely you are not consuming your money today. That consumption is foregone. That consumption you are not able to consume. That is foregone to earn a return today. So interest rate throughout curriculum can be viewed in three different ways. And what does interest comprises of? We have covered it over here. Okay. Are we good till here? Any confusion? Any doubt?
Yes.
Okay.
Clear.
So I'm clearing all my diagrams. So we'll not delve into the example thing, but yes, there are four elements to this. Number one is annuity, simple interest, perpetuity, and compound interest. I hope that you guys would have come across this term throughout your life. Simple interest. So can anyone help me what simple interest and compound interest is? Anyone who wants to take a stab on this? What is the difference between simple interest and compound interest?
Maybe simple interest as a short term, and compound interest maybe for the long term, or as a term.
Not term related. Anyone else?
Oh, it is the first time.
Okay. So basically the simple interest is, see, let me explain this way. Okay.
No simple.
Suppose you invested your money in a bank. $100 in a bank. You invested your money in a bank,
Okay.
$100. Okay. At the end, the bank is offering 6% rate of return. After 1 year, what will your money become? 106. Your balance will show as 106 because $100 is the original principal amount plus you earn an interest of $6.
Yeah.
Right?
Okay.
This is 106.
Okay.
In year 2, bank again is offering
100.
6% return. Which amount should I charge 6% or apply 6%? On 100 or on 106 for year 2?
106.
106.
Because end of years.
106, right? When you
Okay.
say that we have to,
106.
when you say that we have to apply it on 106, this is called compound interest. You are
Okay.
compounding. Compounding
Ah.
means what? Earning interest on interest.
Okay.
When you earn interest on interest, that is called compounding. Okay. And if I would have applied 6% on this 100, that would have been simple interest. That means interest, or you are not earning interest on interest, you are only earning interest on the original principal amount. This is the difference between simple and compound interest. It's very simple.
Okay.
It's very simple. So simple interest and compound interest, I hope things are clear. The formula is here. And you can get all these formulas, everything in whatever the source you are studying from. So be it Institute Math, be it any other reference book, you will get each and everything from there. Okay. So pay focus on understanding the thing. Compound interest is the key. Simple interest, the world does not run on simple interest. So although I have given it, it's part of the curriculum, but definitely this is not the reality. Everyone wants to earn interest over interest or compound their money. So in real life, the things work on compounded basis. Now, what is the formula of compounding, or how you can calculate the same? FV means future value is equals to PV means present value. Now, what is future value and what is present value? As the name suggest, if suppose this is the timeline, 0th day and 1 year, this is the present day or the present value, and this after 1 year whatever is standing is the future year or future value. I hope things are clear.
Okay.
Okay. And if you want to earn interest or apply compounding, then how you can go about it? It's 1 plus I to the power n. So it's basically FV is equals to PV 1 plus I to the power n. Okay. This is the formula for compound interest. It's very simple, guys. Think of it in this way rather than from formula perspective. If I say that you have invested $100 for 2 years at 6%, if the amount is simple interest, you will straight away say the total interest is $12 for 2 years. It's linear concept. If the year was 5 years, you will say 6 into 5, 30% of 100, that is $30. Total interest earned is $30. There is no concept of compounding that is happening. It's simple interest, but when it is compound interest, it will not be $30, it will be much more than $30, because 106, then you apply an interest rate on 6% on 106, which you get as 112 point something. Then again you will apply 6% on the balance amount and keep on compounding the same or accumulating the same. That is called compound interest. Okay, and this is the formula using which you can get the same. Okay, are we clear till here?
Yes.
Yes.
Okay, great. Okay, the third thing is annuity. I'll come to annuity. Okay, let me explain it here only, or rather I will come to annuity after a few slides. Okay, so we are not touching base on annuity now. We will come to annuity after a few slides. Okay, let me move ahead. Okay, I hope you guys are clear with the calculator thing. You know how to use the calculator. Do
Okay.
you guys have the Texas
No,
calculator? In case you don't have Texas calculator, you can download that calculator via an app, basically on your mobile phone. That app is available on Play Store. You can use that to temporarily solve the thing, but in exam mobile phones are not allowed, so you will have to purchase a physical calculator. Okay,
okay.
so for time being, if you are like practicing or something, you are doing a practice and you don't have it, you can download the app and go ahead with it. Okay. Okay, so calculator thing, basically usage of calculator. These are some of the keys. This is the screen of the calculator, basically the look of the calculator. There are various functions on calculator which helps us solve different CFA related questions. The first function that I introduced to you is the time value of money function. So the 5 buttons that you see on the image, these are the time value of money functions. Let me introduce N, I by Y, PV, PMT, FV. Now what is PV? Present value. Present value means the amount that is standing today. Present value means the amount that is standing today. Future value means amount that is standing at any point of time in future. It may be 1 year, 2 year, 3 year. It may be 1 day also, because tomorrow is also future. Tomorrow is also future. So anything that is standing in future. N is the number of periods of compounding. Now think of it in this way. In our example, we told that 6% is the rate which is compounded annually, and 12% and the time period is 1 year, correct, or 2 years.
Okay.
What will happen if I say you that it is not 6% compounded annually, but it is 6% compounded semi-annually. How does it make the difference?
What?
If I say that it was 6% compounded annually, now I am
Okay.
saying it is 6% compounded semi-annually. How does it make the difference? Or what will your approach be then?
Semi-annually, it's 6 divided by 12.
Definitely.
You
It's
have to
60.
adjust the rate.
It's not 6. Yeah. So your approach is correct. It's not 6 divided by 12. It will be 6 divided by 2. That
Oh,
is 3%.
okay.
See, it's very
Oh,
simple.
great.
See, understand it in this way and don't overcomplicate. Although we have rules for that. So I will share some simple rules for that and that will make things much clearer. So, okay, let me go into that first. 1 second. One second. Let me go ahead first. I will come back to this. Yeah. Yeah. Okay. Let me come to this portion first. Okay. This is a situation. Dennis takes a loan from Bank of America of $6 million. Bank of America charges 8% per annum compounded semi-annually. Okay.
Okay.
Compounded semi-annually. Duration of the loan is 10
Okay.
years and repayment has to be done in equal monthly installments. EMI, we all know what EMI is. Equated monthly installments. Now, the thing is that Bank of America is charging 8% per annum compounded semi-annually. How will you go about it? If things would have been annual, it would have been very easy. You could have just plugged into your calculator. I hope you can see the calculator.
Okay.
1 second, someone else
Okay.
has joined. Just a second.
Semi-annual period, number of
Okay.
period.
Okay. Just a second.
Okay.
Okay. Drumil and there is someone else. So can Drumil and some who is the next person? TWKG QTM. Can they introduce themselves once so that I know who the audience is? Hello.
Could you hear me? Sir?
Yeah, we can.
Okay, so I'm Brumil. I'm currently residing in Germany. I
Okay.
recently finished my master's in
Okay.
physics
Okay.
and want to make a transition in the field of finance. So preparing for CFA level 1.
Oh, okay. Great. Great. Drumil, we have some 2 candidates from Lebanon and 2 candidates from Mauritius over here. So good
Okay.
to meet you. Who is the other person? It's TWKGQTM. So can the person please introduce? Okay, I will move ahead with this example once and then we will have the meeting. Okay. Uh, okay. So can you please not write over here on the screen because so that it helps me to do that. Okay. So monthly and semi-annual installment. I hope things are clear. How will you deal with that? The first question arises. So here are the rules to convert, and it's very simple. It's very simple to do the conversion. Just focus on these rules and you will get it. Rule number 1. If there is anything in this world, any interest rate in this world that writes as, just a second, that writes as X percentage per annum compounded annually. If anything is compounded annually, so you see 6% per annum compounded annually, 8% per annum compounded annually, X percentage per annum compounded annually. If the word compounded annually is associated with that, remember one thing, it cannot be divided by anything in this world. It cannot be
Because it's
divided by anything in this
annually.
world because it is already standing at annual. The approach will
Yeah.
be make a factor. Now, what do you mean by making a factor? Making a factor means if it is 6%, what will be the factor of 6%? 1.06. If it is 8%, what will be the factor of 8%? 1.08. If it is 12%, what will be the factor of 12%? 1.12. Okay, so
Okay.
what will be the factor of 50%? Lilian, can you tell me? What will be the factor of 50%?
50%.
Yes.
1.5.
1.5.
Ah,
1.5.
yeah,
1.5.
yeah.
1.5. Factor of 75%, Karishma. Or Vasudha? Factor of 75%.
1.75.
1.75.
Yeah.
Karishma, are you there?
Yes, I'm here.
Yeah,
Actually,
factor.
I didn't have my
Yeah.
calculator with me.
Yeah, factor of minus 8%. This is also very important. Factor of minus 8%.
0.98.
0.8. No. Oh,
No,
okay.
minus 8%. It's very simple, guys. Factor means 1 plus I. Factor means 1 plus I. So 1 plus 12% factor is 0.12. So that means 1.12. Similarly, 1 minus 1 plus of what I said, minus 8%. So minus 0.08. That will be 0.92. This is very, very important. That's why I told this is the basics.
Okay.
That will keep on getting repeated throughout the curriculum. You will need this knowledge throughout the curriculum. Okay, so that's why you have to be very clear with this. Make a factor. What I say is make a factor.
Make a factor.
Yeah, and play with the power. If
So for the first of the factor 1 plus 0.08. This is the factor 1, yeah?
yeah, this is
Or
the factor
not?
1 plus 0.08. If I say, let me be clear
It's a
on this.
formula.
It's
Yeah.
basically a formula, but take it as like on a verbal basis. If I say it 15%, what will be the factor of that?
1.5.
15,
Okay.
15%.
1.015. No.
1.05.
1.15.
1.15.
1.15.
Oh, 1.5.
It's very simple, guys.
Okay,
It's
1
very
plus
simple.
I.
Yeah, 1 plus
Yeah.
I. 1 plus I. And that I is in decimal.
Okay.
That I is in decimal. Okay. It's very simple. You lend me $1 and you are charging a
Okay.
6% interest. What will you receive back after 1 year?
1.06. 1.06.
Now the calculation is so clear. 1.06,
Yeah.
$1.06. I think that is the
Yeah,
that is what
yeah,
you will
yeah,
receive.
yeah.
Think of it in that
Yeah,
way.
yeah.
If you are lending $1, the rate is 50%. What will you get back after 1 year?
1.5. 1.5.
$1.5.
1.5, yeah.
$1.5. So think of
Yeah.
it in that way. Think of it in that way. That is what you are saying is correct. That is factor. That is
Yeah,
factor.
okay. Yeah.
You lend $1. This is the interest rate. What you will get back. Then automatically you
Okay.
get your factor. Okay. So now the approach is that if you have, if it is compounded annually, okay, then you cannot divide it by anything in this world because it is already standing at the year end. Make a factor, play with the power. Play with the power means that you know how to apply a power, right? 1.12 to the power of, suppose now I want to move back to 6 months. If I have to move back to 6 months, what I will do is I have to deal with it on a power basis. I have to do it as 1 by 2. If I have to move back to 3 months, I will have to do it as 1.12 to the power of 1 by 4.
دكتور play with the power يعني How months yani? How we
Wait.
how much?
Okay. So when I say this is the timeline, okay, this is 0th day,
Timeline, okay.
this is 3 months, this is 6 months, and this is 12 months, right?
Okay.
Right?
Okay.
Right? Now,
Okay.
since suppose this is 12% is the rate, 12% is the rate compounded annually, 12% per annum compounded annually. Where does this 12% stand? Over here, right?
12 month. Yeah,
12 month. I am saying
Well,
make a factor of it, number one. So it is 1.12 now. You have
What?
made the factor.
Yeah. Yes,
1.12.
exactly. 1.12.
okay.
Yes.
It
Okay.
cannot be divided by anything in this world.
Because it's annually. Yeah.
It is already standing at 12 months. It cannot be divided by anything in this world. Now, if I say I want you to find an equivalent 6-month rate, means
So it's semi-annually. Yeah.
it should be semi-annual. Give me a rate that at the end fetches the same amount as 12% per annum compounded annually, but I want to
it's
write
not-
as X% per annum compounded semi-annually.
So it must be 6%. So the factor 1.06.
Exactly. It's not the 6%. It will be now what you will have
Divided
to,
by 2.
no, not divided by 2 now. What you will have to do is that you have made the factor. Now you cannot divide it. You have to move backwards. Basically, in
Okay.
power mode, apply 1 by 2. Why 1 by 2? Basically, you are doing 12 by 6. Basically,
months.
12 by 6. It's very simple.
Okay.
Okay.
Where are you? See this formula. This formula you will not get in institute math, but for explanation purposes, I have done this. 1 plus I by m. What is m? I will explain, but think of it as 1 plus I by m. Where you want to go in timeline? Where do you want to go in timeline? Divided by where are you in the timeline? If you think it in this way, you will never make it a mistake. So if suppose
if I moved back 6 months, so the I is 6 months over M's.
Exactly. So basically here 1.12, where you want to go in the timeline. If you want to move to 6 months, you want to move to 6 months, right? So on power you will put as 6, divide where are you on the timeline. You are standing already at 12. So 1.12 to the power of 6 by 12.
Okay.
This is the way to deal with this. Okay. The second thing is, if interest rate is X percentage per annum compounded M times a year, anything other than annual, if that is the case, then how are you going to deal with that? In that situation, you have to first divide the rate by 2. So if it is 8% per annum compounded semi-annually, you will straight away say it is 6%, 4%. 8% per annum compounded semi-annually, you will straight away see it as 4%. Okay. If it is 8% per annum compounded quarterly, you will see it as 2%. So what are you doing is you are removing the effect of this compounded M times a year, semi-annual, quarterly, that compounding. 8% for 6 semi-annual means 4% in 6 months. Okay. In that case, what you will do is first divide it by M. First divide that thing by M, then make the factor and then play with the power. First bring it to that level. So let's do it in let's solve an example. I think then it will be more clear to all of you. I think this will make things much more clear. Okay, we will be solving this example.
Okay.
Yeah. So let's solve this example. Rate is 10% per annum compounded annually. Okay. The rate is 10% per annum compounded annually. Can this be divided by anything in this world? The first question.
No.
Can we divide it?
No, must not divide it because it's
Must not.
annually. Yeah.
It is annual. It cannot be divided, right? Find equivalent semi-annual, quarterly, monthly, daily compounding rates. You have to find the
Okay.
equivalent semi-annual, quarterly, monthly, and daily compounding rates. Okay. First, see this example. We have an example
Okay.
for homework as well that you will take and you will solve it. So don't worry. First, understand the approach. That is more important. How are you going to deal with this? See, now 10% is standing at 12 months, or if it comes to days, it is standing as 365 days, right?
Okay.
If I am to bring it back to 6 months, or I have to find the equivalent 6-month rate, what should be my approach? Step 1. Can the rate be divided by anything in this world? Please respond. Can we divide it by
No,
anything in
since
this
it's
world?
annual, it's annual,
No.
so it must not divide it. But
So we cannot divide it, correct? It cannot be divided by
Yes.
anything in this world. Number 2.
no, but moving backward to 6 months, so it can be divided semi-annually,
No,
right?
that
Or
doesn't
no?
depend on semi-annual thing. That depends on your rate, what it is written in which format. So your
Okay.
10% per annum is written in compounded annually format. That is why it cannot be divided. Division does not depend on where you want to go. Division depends on what the rate is quoted in which format. Okay. It
Okay.
cannot be divided.
Okay.
Directly make the factor 10%. What will be the factor of 10%? 1.1?
1.1. Yes.
Yes.
1.1?
Yeah.
Yeah. Okay. Now, where are we on the timeline? Where are we standing? Where this 10% is standing in the timeline? At 12 months?
On 12 months, yeah. 10%.
At 12 months, correct? Are we good?
Yeah.
Yes, yes.
Where
Yeah.
we want to go in timeline? Where we want to go in timeline?
Semi-annual.
6 months.
We want to go in 6 months, right? 6 months.
Yes.
In that case, how will you solve this one? See, this is the way to solve it. Factor
So,
1.1
yeah.
to the power where you want to go in the timeline. We want to go in 6 months. Where are we? We are at 12 months. Okay. Why do we do a -1? Why do we do a -1? To remove the effect of factor. To remove the effect.
Okay.
We did a 1 plus. We did a 1 plus that, right? When we made the factor, we did a 1 plus I. That is a 1 plus
Okay.
0.10. Correct? And then we got a
Correct.
1.1. Now, when my
Okay.
purpose is served, I will have to remove this one again. If I have added one, I've onloaded something, I have to offload that also, right? Towards the end. So that is why I am removing this factor to get the interest rate. Now, why
Okay.
is this 12 by 6 being done? It's very simple that what rate you are getting over here is for 6 months, that is unannualized, or for that period only, that is unannualized. And interest rates are always quoted annually. No exception to this rule. You will always get interest rate on an annual basis. That is why it is multiplied by 12 by 6. 12 by 6 means you are converting it into annual, and then it is 9.76%.
Okay.
Did you guys got it? We have more examples, but is it clear? If there is any confusion, do ask. We will do 2 or 3 more examples on this, but if there is any confusion, do ask.
No, it's clear.
It's clear? Vasudha, Karishma,
Yeah.
Yes.
Yeah, it's clear.
it's
Yeah,
clear? Okay.
Yeah.
Now, if what will be your approach if this same thing we will have to do, but now we will have to convert it into 3 months? What will we do?
Quarterly, 1/4.
1 over
So,
4 or 3,
yeah.
1 over 4, that is quarterly, but here how we will solve it? How we will
So
solve it? Yeah,
1.1
to the power
Okay.
1.1 to
For,
the
for
power
what?
4 divided
by
by
12.
12.
4 or 3 divided by 12. Quarterly is 3 months, right?
Quarterly.
Yeah, 1/4.
Yeah, 3 by 12.
3 by 12, right. 3 by 12
Yeah.
minus 1
Minus 1. Okay.
into,
And 12 by 3.
right, 12 by 3 into 100. Into
Okay.
100 to convert it into
Okay.
percentage, because you will get things in decimal. Now please solve
Okay.
it on your calculator. What do you get? What are you getting, guys?
9.6.
9.6. Is everyone getting the same answer?
Yes.
Let me check. .65 or something you would have got in this, like this
Okay.
only.
Yeah.
Okay. If you would have wanted to convert it in 1 month, I hope now you got the approach. How you will go
Okay.
about for 1 month, 1 by 12 and then 12 by 1. Is it clear? If
Yes.
you would want to
Yeah.
go for 1 day, 1 day, daily
1
compounding,
day.
1 day, daily compounding,
Instead
then,
of 12, we would have used 365.
right, and then 1.1 to the power of where you want to go 1 day. Where are you?
1 by 12.
365 days. You are standing at 12 months, right? That means 365 days. So 1 by
Okay.
365 in minus 1 into 365 by 1.
Yeah.
In that way you get compounded
Okay.
daily. See, these are equivalent rates. So let me make one thing very clear. Although calculation, I think you have got it. If anyone gives you 10% per annum compounded annually, if anybody offers you 10% per annum compounded annually, 9.76% compounded semi-annually, 9.65% compounded quarterly, 9.57 compounded monthly, or 9.53 compounded daily, your ending net worth, ending wealth, or ending value will be same after 1 year. Means
Okay.
these are equivalent rates. These are those rates which will make you indifferent towards all. These are those rates. Okay. So when you convert it into 6 months, the 9.76% you will not write as compounded annually. You will have to write it as compounded semi-annually. This you will not write as compounded annually, compounded quarterly. Means when you are converting it into 3 months, 6 months, or whatever daily, then that nomenclature is also getting changed to compounded daily, compounded monthly, or compounded quarterly. This is very, very, very important. See, the rate is not important. That is just a number from exam perspective. But what is written after that rate, just after that rate, what is written, that is more important, because that is going to determine whether you are able to solve it correctly or not. Okay.
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 Now I am trying to relate you to my formula. Okay, I think now you will be able to better understand, because this you will not get in CFA Institute Math as well, or any textbook. This I have written this formula in a language that I think may be more easily understandable by candidates. Okay. Now if rate is X percentage per annum compounded annually, We cannot divide it by anything in this world. We did not divide it 10% by anything. We just made the factor, and wherever we wanted to move backwards, we have moved basically using power. Okay, 3 by 12, 6 by 12, 1 by 12, 1 by 365. Correct?
Correct.
The formula is where you want to go in timeline divided by where you are in the timeline. -1, you know why I did -1? To remove the effect of factor. By total time in 1 year in timeline. So in 1 year, what is the total time we have? From months perspective, 12 months. From days perspective, 365 days. Correct? Divided
Correct.
by where you want to go in timeline. Why I have done this to annualize it, to make it an annual rate. Okay. Till this period, it is an unannualized rate. Here, it will become an annualized rate. And into 100 because we have to quote it in percentage. It cannot be in decimal. Okay.
Okay.
The next is rule 2. Basically, if anything is m times compounded a year. So my question is, if something is semi-annual, how many times it will be compounded in 1 year? If anything is semi-annual, how many times it will be compounded in 1 year? 2 times?
2 times. No.
Right? Quarterly?
3 times. No.
4 times. Trimester is 3 times. Quarterly is 4 times. Right?
Yeah.
Right.
Monthly?
12.
Wow.
No.
Monthly is 12 times. There are 12 months in a year. There are 4 quarters in a year. There are 2 semi-annuals in a year. There are 3 trimesters in a year. Right? There are 365 days in a year. So if they say that compounded m times a year, when I say m times means it can be quarterly, semi-annual, monthly, daily, whatever it is. Your approach will be very simple. First, divide that thing by m itself. Divide that thing by m itself means semi-annual there are 2 semi-annuals in 1 year, right? If it is written as 8% per annum compounded semi-annually, that means divide the rate by m itself, divide it by 2 itself. If there are 4 quarters in this in 1 year, right? If they say 6% per annum compounded quarterly, divide it by 4 itself. So 6 by 4, that is 1.5. If there are it's say compounded monthly, then divide it by 12 itself. Similarly, go ahead. Then make the factor of that thing. So 8 by 2 is 4%. You make a factor of 4%. You are standing now at 6 months. Then you can move forward or backward depending on wherever you want to go using this same formula. Okay. We'll have an example for this, but just to lay a premise of the entire thing. Now let's move ahead with the example that we have. This is done. Now this example is what we have. Rate is 8% per annum compounded semi-annually. This time it is semi-annual. Okay. When I say 8% per annum compounded semi-annually, what do you see as 8% as? This is very important. You should not see it as 8%. If it is written as 8% compounded semi-annually, you should stop seeing it as 8% anymore. And you should start seeing it as something else.
4%.
4%. If I would have written here as, or in my next example, if I write over here, rate is 6% per annum compounded quarterly, what do you see? I don't see 6% anymore.
1.5.
1.5%. This is the key to success in this particular area of CFA. You should stop seeing it as 6%. You should start seeing it as 1.5%. Basis what is written after this thing per annum. It is compounding frequency. Okay. Okay, great. So now you see it as 4%. Everyone is on same page. We are not seeing it as 8% anymore. Everyone sees it as 4%. Okay. Now the timeline is there.
Okay.
When we say 4%, where does 4% stand? at 6 months, correct? 4%
Yes.
stand at 6 months. So let me write it over here. 4% stands here, or let me use another color. 1 second. Yeah, 4% stands here on 6 months or 180 days, correct? Now make the factor of 4%. What will be the factor of 4%? 1.04,
1.04. Yes.
right?
1.04.
Then make the factor and then play with the power.
Okay.
That means now once you have reached till this area, now you can play with the power. You are free to move vertical, horizontal, whatever way you want to. You can move ahead with the power itself. Is it okay?
Okay.
Now if I ask you to find
Okay.
the equivalent annual rate, how you will do that? How you will do that?
Annually? You
Yeah,
mean
annually.
annually?
1.04 12 by 6 months,
Right,
يعني
right.
180
12 by 6
minus 1
minus 1
-1.
minus 1. Okay. And
into
180 by 12.
180 by 12. No, 180 is days and 12 is months. So we have to keep everything in same format. Means you cannot have a day by month or month by day. Either it will be month upon month or days upon
And
days.
6 by 12.
Right. 1 second. It will be no. It will be how many? What was the formula? Go back to the formula then. What was the formula? The formula was
Okay.
total time
Total
in 1
1 year.
year. So
1 year,
how
yeah.
much time you have in 1 year? 12 months.
12 months, yeah.
And where you want to go? 12 months.
To 1 year. No, month,
1 year. That means 12 months.
yeah. 12 over 1, no?
Total time in 1 year in
6
timeline
by
is
6 by 12. 6 by 12.
no. Why it will be 6 by 2? See, here till here we are correct. Okay. Now my question is what the formula says. It's not just inversing this number. The formula says that total time in 1 year in timeline. So how much total time do we have in 1 year? 12 months.
12 months, yes. 1 year.
That is pretty clear. We have 12 months, right? We don't have 24 months or something. We have 12 months total time in 1 year. That is 12 months, correct? And where you want to go when you are using this, where you want to go in the timeline? We want to go in 12 only.
Oh, 180.
180 is in days. If you are using formula in days, you
Oh,
have to
12.
keep everything in days.
12 by
180 is
12.
the 180 is the
12
days, right?
So 12 over 2 because it's semi-annual.
See.
Semi-annual.
Rate is semi-annual, correct?
Okay.
Where you want to go? We want to go in annual.
So
Okay.
as a 1 year.
That is why this is where you want to go. This particular is where you want to go in timeline.
Okay.
You want to go in
Okay.
12.
12.
You are already standing at 12.
Oh, okay. Understand.
Okay.
Okay.
So now at last into 100 to just convert it in percentage. Please solve it.
Okay.
Tell me
Okay.
what you get.
Okay.
Oh, it's clear now.
-8.16.
8.16%. Let me see. Yes, 8.16 percentage per annum compounded annually. It is compounded annually.
Okay.
Okay. Now, can you guys help me with this quarterly? What you get for quarterly if I ask you to do it in quarterly?
1.04. 4 by 6.
3 by 6.
4 by 6.
Quarterly is
3.
3.
Oh,
Quarterly is
quarterly.
3.
Quarterly. Okay.
Yeah, 3
3,
months.
3 by 6. 3, 3 by 6. Minus 1 equals 3 by 12.
Yeah, by the time they solve Webhub, hello Webhub, are you there? Okay, what answer do we get for quarterly?
$32.97.
No, 32.97 is not, cannot be. It is, see, think of it in this way. 8%. Okay, see, this is the answer we have for quarterly. Check where you made the mistake. 3 by 6. I think everyone did this correctly. Minus 1 into 12 by 3.
Mohit, why is it 6? Can you explain to me?
Because we are standing at 6 months. See, when you are using which rate? 4%? Correct?
Yes.
The question is where this 4% is standing in 6 months.
Oh, okay. Oh, yeah, I understood. Okay.
Okay, is it clear?
Yeah, it's there.
Yes.
Everyone? Okay.
Yes.
Okay. So I hope you got the essence of how the formula works basically, or how the conversion works. Now going back, uh, this is an example or the homework you can say to check your thing. You can, or I will send it to you. You guys can solve it at your level. Okay. Answers are given, but the calculation is not given. So you guys can do a check of how, whether you have got things correctly. Okay. Just a second. Let me jump back to where we left. Yeah. Okay. So now coming back to this calculator thing, I hope PVFV is clear. That was already clear. PV means present value, FV means future value. N means not number of years. N means number of periods.
Okay.
N means number of periods. So if it is 2 years, you will enter and compounded annually. If the rate is 8% per annum compounded annually and it is 2 years, then you will enter here 8 and here 2. I by Y is interest rate and N is the number of periods of compounding. So please listen carefully. If it is 8% per annum compounded annually for 2 years, what you will enter at N is 2. What you will enter at I by Y is 8. That is interest rate. But if it is 8% per annum compounded semi-annually for 2 years, what will you enter then? In N, you will enter 4.
Oh.
Why 4? Because in 1 year,
Semi-annual.
it is semi-annual. So in 1 year, there are 2 times compounding happening. So in 2 years, how
Okay.
many times compounding will happen? 4 times?
4 times compounds, yeah.
So N means not number of periods, but not number of years, but number of periods. Students make confusion
Number of
over
periods,
here.
yeah.
Number of periods. And I by Y is, then I by Y will be interest
And
rate per period,
It's just,
not the annual rate. So 8% per annum compounded semi-annually means 4%.
Oh.
You will not see it as 8% anymore. You will see it as 4%. Enter here 4. Is it clear?
yes.
Yes.
Okay. PMT is something which I have not explained you. I will explain it with NVT. Now, future value of a single cash flow, it's very simple, but let's quickly verbally do this. Suppose 2 lakh is invested today in a bank account at 6% interest, compounded annually for 5 years. Calculate future value. You are asked to calculate future value. How will you go about it? So suppose you have $2 lakh which you have invested today in a bank account at an interest rate of 6% per annum compounded annually, and that is for 5 years. How will you do that? What will be the future value that you will get? How will you calculate?
So the present value is $2,000.
Yes, it's $2,000. No, it's not $200,000.
So 200, yeah, so. And the N is for 5 years. Yes. So the factor 1.06, and represents the period. That's mean 5 times compound. So multiplied by the present value. So this is the future value, what we get, to 67.
Has anyone got this amount, 267,645?
Yes.
Yes.
Great. So see, the approach is very simple. Future value is equals to present value into 1 plus I to the power n. Power n. This is the formula of compounding. Your present value, as Lilian said, present value is $200,000. 1 plus I is the factor thing. Nothing new. It is the factor thing. So if the rate is 6%, what is the factor? 1.06 and to the power of 5.
Yes.
When you solve it, you get your answer.
So it's simple.
It's simple. There is nothing
Yes.
complicated. It's very simple. Now suppose if I ask, and this is how you will do it in calculator. So I have suggested 2 approaches. One is without TVM function, the function that I just shown above, and one is using TVM function. So this one is using formula, and this one is if you use TVM function. So you have to plug in N5, I by Y as 6, PV as 200,000, and then you have to compute FV basically. That depends on the way you want to do that. Next is what will happen if I ask you to do a present value of a single cash flow. What will happen? Suppose this time $5,000 is standing at after 5 years and the rate is 12% per annum compounded annually. What will be the present value? How you will calculate? Using the same formula, FV is equals to PV 1 plus I to the power n, or PV is equals to FV by n
FV
Yeah.
by n.
Yeah.
Correct?
1 plus
So
R to the power n.
yes, 1 plus I to the power n, FV divided by 1 plus I to the power n. In that way it is a
So the
present.
same, we're using the same formula, yeah.
Yeah, it's the same formula. It's very simple. Present value, the amount will be lower. Future value amount will be higher if we are in a positive interest rate economy. Any confusion? Because in future the amount will increase. You will earn interest. In present, if you are pulling it backwards, the amount will decrease at the present. Correct?
Correct.
Yes.
Right. Now comes the annuity thing. Can anyone introduce annuity or explain what annuity is?
Annuity, it's what interest rates paid at the beginning of the year or at the end of the year or the maybe
Interest rate, or is it something related to amount?
or
Amount.
it represents the period at the beginning or at the end of the.
That is right. Either it is ordinary annuity or it is annuity due that you are talking about. But what
Yeah.
annuity is? What is the meaning of annuity?
It shows the series of payments that's happening during the period given.
Right? When the same amount, see, when that same amount, a same amount is getting repeated year over year over year, or at a continuous frequency or at a set frequency for a particular period, it has a tone, a rhythm in that series. That tone or that rhythm is captured by annuity. That is called annuity. The difference between this series of cash flows and the one that we did above is $5,000 is appearing only once. $2 lakh is appearing only once. $200,000 is appearing only once. But here $500 is getting repeated year over year over year. Number one, the gap or the frequency of this repetition is same. Every year at the end $500 comes. Number one, that is thing. Number two is that. Number two is that this amount is getting repeated. The amount is same. The amount is not changing. If these two things happen for a particular period, then that thing is called annuity, and that is captured by the PMT button. So if you enter anything on the PMT on your calculator on that button, that calculator will accept as this amount will get repeated year over year over year. It's very similar to EMI. We all know bank loans, about bank EMIs, right? So you take a loan from bank let's assume $100,000, and then you repay every month, suppose $1,000. So that same
So the
thousand,
same.
yeah, that's the same. So same $1,000 is getting repeated year over every month over month over month at the same set frequency. This particular thing is called annuity. Is it clear? The concept of annuity, same amount
Yeah.
gets repeated period over period at a set frequency for a finite period. That is called annuity. Okay. Now, if this be the situation that is given to you, then how will you deal with it? The one way to deal with it is to view every $500 as individual cash flows. So I will do a calculation. I will do a PV of this $500 first, then a PV of this $500, and so on and so forth till 10th year. So let's assume this is the example, assuming that an investment scheme promises to pay $500 every year for 10 years. If the required rate of return is 8%, calculate the present value. If this be the situation, then how you will go about it? The first way is you use the compound interest formula and then calculate the PV. 500 divide 1.08 to the power 1. Then this 500 divide 1.08 to the power 2, and so on and so forth till 500 divide 1.08 to the power 10. Am I clear? This can be the first
Yeah.
way of doing this. The better way to do this thing is to use the PMT function of the calculator. So in your calculator, if you can see the calculator on my screen, I mean, I have put it here is the PMT button on the calculator. In this PMT button, you can use this, you can plug in this 500, and when you solve using this time value of money function, you get the correct answer. So you can deal
So
with
in,
this annuity.
so PMT is the same repeated amount period after period, yeah?
Yeah,
So-
period after period at set frequency. That is
Yeah,
annuity.
okay.
Okay. So
Okay.
if we are to solve this one, if you guys don't have calculator, I will, and if you guys have, then do use that calculator and solve it. See, first I will press the second and the FV button so that I can clear whatever the existing entries are. Okay. Then I will have to calculate the present value of this series of cash flows. It is 8%. So I will press 8 over here and I by Y over here. I will press a 10 over here and on N, just a second. I will press an 8 over here and I by Y, and then a 10 and N. So N is 10 years, means number of period is 10 years, and I by Y is 8%. So I have done that 8%. Now I will plug in 0 as FV as there is no future value that remains. I will plug in 500 as PMT. PMT means
Okay.
when I enter 500 on PMT, calculator will take it as this 500 is getting repeated year over year for 10 periods, because on N we have entered 10. So for that period it is getting repeated year over year, and interest that is being earned on it is 8%. Now if you calculate present value, compute PV, you get the answer, that is 3355. So this is the present value. Just a second. This is the present value that is there on your screen that I get on calculator. So just to show, in case you didn't had the calculator, this is the way to deal with annuity situations.
Okay.
Okay. From here onwards, calculator will play a major role. You have to understand things, but calculation will not be much. It's basically using calculator we will solve things. Okay. Guys, it is clear? Vasudha,
Clear,
Karishma,
Yes.
it is clear. Okay.
Yes.
Abdul,
So
is it
there is
clear?
I want to ask if there is a formula to include PMT as a formula, not as a calculator, or we are using
There is a formula for annuity as well, just like a formula for compound interest, but that is beyond CFA curriculum. because that is
Okay.
a relatively complex formula. And since you have
Oh,
business calculator that is allowed, so you don't need to remember that formula. Although there is one formula for
okay.
NVT as well.
Okay.
Okay. Similarly, you can calculate future value also. Nothing new. Determining amount of ordinary annuity when PV is given. In similar fashion, you can calculate that thing also. So these are something which once you get the annuity thing, it will be easier for you to do that. That will not be a challenge for you. Now coming to annuity due. One second, my amount of ordinary annuity when annuity, that is not the thing. Annuity due. Now, as Vasudha was saying, there are two things that happens. Okay. Number one is the first thing was annuity, ordinary annuity, and the new thing that you will see is annuity due. Now you will say, what is the difference between an ordinary annuity and an annuity due? The difference
Okay.
is here. The difference is here. Just a second. This is the cash flow series of an ordinary annuity, and this is the cash flow series of an annuity due. See, an ordinary annuity on 0th day, it does not have any cash flow. The first
Okay.
cash flow starts from year 1, then year 2, and then it keeps on occurring till year 10. When on 0th day an annuity does not have any cash flow, but on 10th year or on last year it receives the final cash flow, it is called ordinary annuity. However, it may so happen that on 0th day the first cash flow occur, as in case here. So the first cash flow is occurring on 0th day and so on and so forth. However, in the last year there is no cash flow that is occurring. So when I say on the 0th day means first payment is being made today. When I say 0th day means first payment is being received today. If this be the situation here, first payment was being received after 1 month in the ordinary annuity, but here first payment is being received today. This results in a situation of annuity due or beginning of the period annuity. Yes, there was some any question?
So ordinary the ends of the period, annuity due at the beginning of the period we have the
Yes.
cash flow.
Yes,
the
yes,
difference,
yes,
the main
yes.
difference between
That is the
two.
main
Yeah.
difference. Yes, that is the main difference. That is the
Yeah.
main difference. Okay. In that situation, there are two ways to solve this. The first way is what the difference will be. See, the total of the cash flows, the total amount of the cash flows does not change. First understand. Here also, if you do a total, the total is $5,000. Here also, the total is $5,000. So there is no change in total because 500 has come 10 times, 500 has come 10 times. The only difference is that here we are receiving it 1 month or 1 period earlier. If that be the case, what do you think? Which one will you prefer? This one or this one? Tell me. Which one will you prefer?
At the beginning, I prefer maybe but the way the
Yes,
cash flow.
because
So annuity due because it's more safe maybe or more to have a cash flow between hand by our hands or so.
yeah. So, Karishma, do you think it is the same?
Yes, I share the same view.
Why so?
Um, we are having cash beforehand.
Right. And with that cash, what you can do if you have it beforehand, you can
Mm,
invest
Yeah.
and
yes.
earn interest for that particular period. That is the difference between annuity and annuity due. See, this is the formula. PV of annuity due is equals to PV of ordinary annuity into 1 plus I. And in case of FE of annuity due, that is also FE of ordinary annuity into 1 plus I. What does it mean? That if the ordinary annuity due, the amount was 3355.04 and rate is 1.08%, you can just multiply it by 1.08, that is the factor of interest rate, periodic interest rate, and you get the same amount at the end. I mean the amount that is you get at the beginning of the period. Although I don't suggest this approach, there is an easier approach to deal with the same thing, and the easier approach is to set your calculator in the BGN mode, that is beginning of the period mode. It is already given over here to set the calculator at the BGN mode or beginning of the period mode. How to go about it? It's very simple. Second PMT, second enter. 4 buttons, second PMT, second enter. Once you do that, on your calculator screen, the BGN word will be highlighted, as it is in my case. The BGN word will be highlighted. Okay. Once you do that, your calculator is set for the BGN mode. Now it will take all the time value of money questions as the beginning of the period mode. In case you have it, you just plug in the numbers as you would do in case of ordinary annuity and calculate it, you will get the correct answer. So
Okay.
although there is a formula, that formula is basically for understanding purposes, but for exam, use the BGN mode, that will be more safe. But yes, word of caution, don't forget to turn the BGN mode off once you are done, because beginning of the period question will be 1 maximum in the entire CFA exam if it will come. So don't forget that if you have activated the BGN mode, your other calculations may get affected if in hurry you forget to turn it off. So do turn it off once you have solved that particular problem.
Okay, this is just for animated due, Bishi, and
Yes, this is just for annuity due, nothing else.
okay.
So if it is
Okay.
annuity due, you can use this function in the calculator. Okay,
Okay. Okay.
great. Last is perpetuity. Perpetuity means perpetual. Perpetual means infinite period, never ending. Can anybody give me an example of what things are perpetual in life? Pension plans. Soldiers fight for their country and government support them by giving pensions when they retire. Can anybody tell when a particular person is going to die? No, no one can tell that.
No.
That means that is also something which can be considered as infinite, because a finite period cannot be put. So if suppose I undertake to give a pension via an insurance scheme or via any other scheme, government gives it. Can anybody say that this person is going to live only till 65 years or 70 years or 75 years or put a particular number? They cannot.
No one can give an exact number.
Exact number cannot be given. In similar fashion, in some countries, irredeemable preference shares are allowed. Irredeemable. Irredeemable means they can never be redeemed. In that situation, these preference shares are called perpetual preference shares. Perpetual means perpetuity. Perpetuity means perpetual. Perpetual means never ending. Something which does not have a limit or an end. Basically infinite. How is perpetuity different from annuity? How is perpetuity different from annuity?
Annuity, it has a period, a number of periods, but perpetual or perpetuity is the long-term period, infinite.
Right. This arrow explains it. Perpetuity has a finite period, 10 year, 20, 30, maybe 100, but it will have a fixed period. But annuity has a fixed period, but perpetuity is infinite. It does not have any particular fixed period. This
Okay.
is the difference. This is the difference. Okay.
Okay.
So the formula for perpetuity is simple. It is PV is equals to PMT by I. It's very simple. PMT means the amount that is being repeated year over year over year. The same amount that you are getting year over year over year, that is the PMT, that is same, divided by I, and I stands for market interest rate, the rate that is prevailing in the market. So if you want to value a perpetuity, how are you going to do that? That same amount is being repeated year over year over year for a finite or infinite period. So take that amount and divide it by the prevailing market interest rate. Once you do that, you get the present value, that is perpetuity. It's very simple. It's very simple. Suppose if this be the case, $5 per share you are receiving annually as dividend. Expected rate of return is 7%. Determine what is the maximum price investors should pay. Or basically, what is the value of perpetuity? That is what you have to determine. Tell me how to go about it. Or what will be the value? Tell me. Karishma, Vasudha, what will be the value?
$462.96.
How did you got that?
For the example, 500 divided by 1.08.
So 500, no, first, one second. 500,
$5.
I am talking about this example. And second, do focus on this thing. This is only I, this is not 1 plus I. Here we are not
Okay.
using factor.
1.07.
0.7.
0.07.
0.07, yeah. And the penalty is $5.
5 divided by
$5
0.07.
0.07. So the PV last year.
This is something which you should get.
0.07.
I got it.
Okay. The price rate.
Okay.
Okay.
It is pretty straightforward. Just divided by the interest rate. So if the amount that is being repeated is $5 and the rate is 7%, just divide it by 0.07. That's it.
Okay.
And not a factor over here. Here it is only I. It is not 1 plus I.
Okay.
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 Great. Now we are learning the second calculator function, that is the CF function. Okay. In CF function, there are three things that you will get to know. One is CF itself, the second is NPV, third is IRR. Now how you use that? See, we have till now covered a series of cash flows, calculating the present value of those cash flows, which has either it was a single period cash flow, or either it was a annuity which has a particular tone or rhythm in that. But in life you will get maximum cash flows which do not have any tone or rhythm, which are erratic. So like what I say erratic is anything which does not have a rhythm. Minus $500, if this be the series of cash flows of a project, minus $500, then you receive 150, 200, 200, 150, 400. Can you apply annuity over here?
No.
No, because there is no tone.
No, there is no. No, there is no same amount cash flow year
Exactly.
after year.
Year after year. So
Yeah.
you cannot
No
apply.
change.
So there is no PMT here.
No PMT here. So there is
Yeah.
exactly, there is no PMT here. If you were asked to calculate the present value of this entire series of cash flows of a project,
Yes,
how you will
okay.
go about it? The question is, then the answer is using the NPV, net present value. Net present value. That
Yeah.
is CF0, that means minus 500, the thing that is standing at 0th day. See, if anything is standing at 0th day, then it cannot be pulled backward further because it is standing
Okay.
today itself. So there is no division is possible. If CF1 is standing up, anything is standing after 1 year, how you will do a PV of that? 1 plus I to the power 1. If anything is standing after 2 years, 1 plus I to the power 2. Anything is
So
standing
it
after,
represents first year, second year, third year, and
right,
so
as
on.
till nth year, 1 plus I to the power nth year, basically.
Yeah.
And this is not a new formula. This is the same formula as compound interest. FV is equals to PV 1 plus I to the power n. That was the formula, right? So if I am to calculate the PV for any particular cash flow, that will be FV divide 1 plus I to the power n. If that FV is CF1, that is standing after 1 year, then it will be 1 plus I to the power 1. If it is CF2, that means it will be 1 plus I to the power 2. And if it
Okay.
is CFN, then it will be 1 plus I to the power n. So in similar fashion, okay?
Okay.
I to the power n, right? Okay. So to avoid doing all these things individually, means if there would not have been any calculator, you would have to solve each and every cash flow individually. For here, you would have to do a minus 500. You would have to do this one. You have to solve this thing individually for all the cash flows, and then you have to do a total of that. But not the case here, as it is said, using formula not advised, but using method 2, which is advised for our case. So use the CF function. How to go about it? It's very simple. If you guys don't know, CF second clear work. So first you clear the concept of CF, I mean clear the data that is there in CF, and then you, when you see CF, you will see a 0, CF0 written over here. Okay, what does CF0 represent? CF0 represent the 0th day value. What value do we have at CF0th day? Minus 500. So just plug in a 500 and then press a plus minus button. Okay, you will see 500 on your calculator screen. Then press an enter and then arrow down. That's there on your calculator. Okay, arrow down, once you press, you will see C01. C01, it is asking for cash flow for year 1. In similar fashion, C02, C03, until whichever number you want to take it up to. It's okay. So here it is 150. I will enter as 150, enter, arrow down. Then it is asking for F01. F01 means the frequency. So suppose if this 150 was getting repeated for 10 times. Let's assume if this 150 was being repeated 10 times, what would have happened? Will you have to enter 150 manually for 10 times? No, you can just enter in frequency 10. And the calculator will automatically assume that, okay, this 150 is being repeated 10 times. And then when you press arrow down, it will reflect C02, but it will take the number as the 11th year cash flow. Okay. So here, since 150 is not getting repeated, I will only enter 1, and then I will move ahead, enter arrow down, then press 200, enter arrow down. Now see, 200 is getting repeated twice, and the repetition has to be in a row. 150 here and 150 here is not a repetition because there is a break in between. Okay. If the repetition is in a row, that is continuously, then only you can use the frequency button. Okay. So here, since 200 is being repeated twice, 200, 200, I will enter 2 in the frequency and then arrow down. Then I will enter a 150 again, enter arrow down, and then lastly 400, enter arrow down. When I press NPV button, it will ask me the rate at which you want to discount. So when you are discounting cash flows over here, you have to use a particular rate, that is 8%, correct? So you also have to give calculator the rate using which they have to discount, it has to discount these cash flows. So that rate is 8% that has to be plugged in. Enter 8i, arrow down, and then you calculate compute NPV. What NPV stands for? Net present value.
Yeah.
Net present value. Net means positive cash flows minus negative cash flows. Positive minus
Okay.
negative. That's why the net word is used, and that is NPV. The answer I'm getting is the same, 351.6186, as you can see on the calculator screen. Okay.
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 Are we clear till here? First, my question is, because
Yeah.
then I will
Yes.
move ahead to the next parts.
Clear.
Vasudha, Karishma, Abdul,
Yeah, fine.
Yes.
Lian,
Yeah.
everyone
Yes.
is clear.
Clear.
Everyone is clear.
Yeah,
Okay,
yeah.
great, great.
Yeah.
So I'm moving ahead. These parts are already taken care of. These are repetitive examples. So once you go through the material, I mean your study material, then you will be able to easily go through this or calculate this. Okay.
Okay.
Use of brackets. See, when CFA Institute, although this is not covered in any curriculum, but from uh, exam perspective, from quick calculation perspective, you should take note of this very seriously. CFA often offers you lengthy calculations, which are quite lengthy, and use of brackets is there. If you are to perform such lengthy calculations, there are two ways. Number one is you break the calculation, I mean you break the entire calculation into subparts, keep on writing the values of what you get as the subpart, and then you total it or do something like that. The second way is to expertise the use of brackets. See, there are two brackets in the calculator, you can see over here, two brackets, open and close these brackets. Using these
Okay.
brackets will help you a lot to solve lengthy calculations. Okay. Suppose
Okay.
Okay.
I have to do this much of lengthy calculation. 5 plus 6 into 2 is equals to 17. Okay. This is the calculation. Now, if I am to do it on calculator, first I have to press a 5, then I have to press a plus, then I have to open my bracket, press a 6, then into, and then 2, and then close the bracket, and then press equals to get 17. You would say, sir, what, this is so simple, I can do it verbally. Now think of it as this is 1 plus I to the power n minus 1, and inside it is 2x plus 3x plus 4x, or whatever the number is. Think of it as a lengthy calculation. Then you will be able to understand the essence that use of this brackets is very important because it enhances your speed. Performing such lengthy calculation otherwise would be difficult or will be time consuming. It will take more time, but if you expertise the use of brackets, then it will be very quick for you. Okay, so this is something which you have to expertise or master your own self. Okay, just a suggestion,
Okay.
do you practice the use of brackets, try to solve lengthy calculations, whatever is covered in this time value of money or will come next to over the during the curriculum, try to solve it in using brackets. If you are able to get the correct answers and you are confident enough to use it in exam, very good, go ahead with that. That will give you a competitive advantage. Okay, however, if you are not confident enough, then don't toss or don't risk your exam any one question also for this use of brackets, because if you are not confident and you make mistakes in bracket, then it doesn't make sense for you to use it. Then you do this approach of breaking it into smaller parts, writing the answer of smaller parts, and then totaling it up or summing it up.
So,
I
but
hope-
it needs a lot of practices to be familiar with these formulas or to use on calculators. So,
Yeah, definitely, that you have to.
yeah.
That you have to,
Yeah.
and this will come over the time. This will come with the flow. So once you start doing the practice solving question, this will come with the flow.
Yeah.
That's why I'm saying, if you have mastered the bracket thing, then very good. If you have not, or you are not confident, then don't go for that in exam. Do break it into subparts and then solve it. However, if you master the bracket thing, then what will happen is you get a competitive advantage against other candidates because your speed increases, your time management improves. Okay.
Yeah.
Okay.
Yeah, yeah.
Now, second part we have already covered, frequency of compounding. I have already explained you everything that was there here. Okay. Now
Okay.
we are moving on to this one, and this is nothing new. Whatever I have explained above is something which is same thing which is being repeated over here, but they have just what you can say, uh, put it in a particular way. So types of yields. See, return is also known as yield. Think of it as synonym, yield and return. What is the rate of return you have earned? What is the yield you have generated? Okay, that is the same thing. So they say that there are various types of yields in the market depending on investor or type of market you are. But the commons are, number one is effective annual yield. Effective annual yield. Now what is effective annual yield? Anything that you can write as X percentage per annum compounded annually is effective annual yield. So is it new or old? We have already discussed. X percentage per annum compounded annually. We already know that. It's just putting a nomenclature to the entire same thing. Okay. So that is called effective annual yield. So above, if I say in all these rates that are available here, which one can be considered as effective annual yield? If I am to ask, then what will be your answer?
Can you repeat the question?
So effective annual yield is X percentage per annum compounded annually, correct? Now
Correct. Yeah.
I am asking that anything, that means any rate after which you can write as compounded annually is effective annual yield. Okay, how are you going to deal with this here? Means what rate over here in this entire slide, which rate can be considered as EAY?
The 8%. No.
16.
8.16. Right, 8.16. That is the rate. Why? Because it is written as per annum compounded annually. There is no other rate that is on annual basis. This rate can be called as EAY, effective annual yield.
Okay.
Okay.
Oh, okay.
Next is BY, that is bond equivalent yield. Now again a nomenclature. Any rate that can be written in the format of compounded semi-annually. Any rate that can be written in the format of compounded semi-annually is called BEY, bond equivalent yield. Again the same question, which rate in this page can be called a BEY?
So,
8%.
Right, 8%. The question itself, which starts with
so
8% per annum compounded
yeah.
semi-annually. So this rate can be called a BEY, bond equivalent yield. Fair enough.
Yeah.
Third is something which is new, holding period yield. This is the unannualized, and this is very important, unannualized. Interest rates are always annualized. Interest rate, be it semi-annual compounding, be it half-year compounding, be it quarterly, whatever compounding it will be, it will always be annualized. What do you mean by annualize? The 12 by 6 multiplication we did in our formula. So in our formula, this is annualizing the interest rate. What we have done over here, this one, as you can see, this is called annualizing the interest rate. We are annualizing it over here. Okay.
And
Okay.
If I remove this from my calculation, then the rates that we get remains unannualized. Holding period is an unannualized rate. First thing, it is an unannualized rate. As I have written 3%, this is not a per annum rate. So suppose how holding period yield works. Suppose you have invested in a stock, okay, and you generated a return of 3% in 40 days. Holding period yield will not let you convert it on an annual basis. It will say 3% for 40 days. That's it. That is called holding period yield. As the name suggests, what is the yield that you have generated for the period you are holding it? Think of it in that way. Holding period yield. So you are holding it for a particular period and you are generating a yield. What is the yield for that particular period? For that period only. Don't annualize it. That is called holding period yield. It's very straightforward to calculate that.
Okay.
P1 plus P1 minus P0. So P1 means what? Is the selling price. P0 is the purchase price plus D1 is the interim cash flow, which can be in form of interest or dividend. So interest, if it is a bond, you will earn interest. If it is a share, you will get a dividend, right? So P1 minus P0 plus D1 divided by P0. Something which is very, very easy and straightforward. It's very simple. You invested in a stock. The stock price was $100 when you invested. After 1 year, the stock is after 75 days. After 75 days, the stock is trading at $103. You bought it at $100. The stock is trading at $103. Okay, and you earned a dividend of $1 in interim during that 75 days. What is your holding period return? What is the return that you have generated or profit that you have earned? Purchase price, let me write it. You purchased the share at $100. After 75 days, the share is trading at $103. In the interim, you have earned a dividend of $1. What is the return you have generated? What is your holding period yield? HPY, holding period yield.
It's
0.04.
It's
it's 103 minus 100 plus 1 over
right.
over 100
Right.
over 100. Yes.
That is 4%. That is 4%, isn't it? It's simple. You have invested $100. You got 404 back. What is the profit you generated?
Yeah.
$4. $4 upon your original invested. That is 100. 4 by 100 into 100. That is 4%. Okay. It's pretty straightforward.
Okay.
Okay. The key to this holding period is that when you will write this as 4% per annum, you will write it as 4% for 75 days. This is the key. Till now, whatever we have written, whatever interest rate we have seen, we have always seen it as 4% per annum. Then we see it as compounded semi-annually, quarterly, or whatever it is. But this is the first time you will see an interest rate which is not write as per annum. It will write as 4% for 75 days. That means within 75 days, you got 4%. Now you have to annualize it. If you annualize it and you annualize it by 12% for 12 months, then it will become EAY. If you annualize it for 6 months, it becomes BEY. If you annualize it in different format, it becomes different things. Is it clear? Holding period yield. It's very simple and straightforward. Money market yield. Money market yield is annualized but on a 360-day basis. So do remember this nomenclatures. Here you will have to keep it in your memory that when institute says money market yield, it is asking for calculating an annualized yield on a 360-day basis, not a 365-day basis. And the most important thing is it is simple interest. It is not compound interest. EAY is compound interest on a 365-day basis. Bond equivalent yield is also compound interest, but this one is simple interest. Is it okay?
Okay.
Yeah.
Yeah.
So now if you are to calculate, this is your HPY rate. HPY means holding period yield return. I asked you to calculate the equivalent MMY rate. What will be the equivalent MMY rate? 4% for 75 days. So what will be the equivalent MMY rate? Use this. 4 into 360 divide by 75. Because it is simple interest. Because there is no concept of compounding. Since compounding is not there, factoring is not there, means you don't need to create any factor anymore. It is a linear thing.
Yeah.
So whatever you get, that will be the answer for MMY. Okay. Lastly, it is bank discount. Yeah. What is the answer?
It's 19.2.
19.2%.
19.2.
Great. 19.2%. Lastly, it is bank discount yield. And in bank discount yield, BDY analyzes the discount on instrument. Okay. It is basically using this formula F minus P by F. So bank discount yield is always calculated on the face value compared to HPY, which is calculated on the original price, that is 100. It will be calculated on the ending value, bank discount yield. So F minus P by F into 360 by T. Again, 360 by T means it is simple interest. It's not compound interest. So two things you see basis simple interest is MMY and bank discount yield. And these are fixed nomenclatures. So we cannot change any of them, or institute even cannot change, because these are nomenclatures that work in finance market. So if you go to T-bill market, treasury bill market in the US, then you get the quotes in BDY format. If you go to CD, commercial deposit certificate of deposit equivalent market or money market in US, you get the quotes in this format, MMY format. So this is something which is not determined by institute, but this is determined by the market itself, US markets. Are we okay till here?
Yes.
Any confusion, any doubt, you can clear now.
Okay.
So again, there are some examples that are there. Let us solve one. I think that will be easier. So use this example and solve.
So it's 10%.
Which one?
10% BDY.
BDY. No, it was HPY, right? Calculate the HPY for a T-bill with the face value of this.
So face value is 100 minus 92 over 100 times 3060 over 2.
Yeah, this is the answer.
Yeah.
100 minus 92 by 92, 8.70 for 270 days.
Yes.
If it is a share and you get extra dividend, then this will be the situation. Because if it is a share, you earn a dividend of $2 as well. Is it okay?
Yes.
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 You guys are able to understand it, okay? In similar fashion, you can solve other examples as well. Okay. Okay, let's do one thing. Let's do a BDY example also. Let's solve this one, the BDY example as well. You have the formula, or yes, this is the formula for BDY.
Yes, we have.
Yeah, I
You
have.
have the formula. Okay. So yeah,
Yeah.
you can solve this. F minus P by F. That means on the face value.
It must be 10.
How much?
10
Let me check. 10.67.
and 65.
Others are getting the same.
Yes.
Abdul, is it okay, or do you want me to explain?
100 minus
92.
92
See, that is
by
the
100.
formula. See, formula is F minus P by F, right? F is the face
Okay,
value
okay,
and P is
okay,
the current price. So in our example, the face value is 100
okay.
and the current trading price is 92.
Current 92.
That
Okay,
is why 100 minus 92 by 100
okay,
into then 360 by T. So since it is standing at 270, so 360 by 270, that means 10.67% per annum simple interest.
okay, okay,
Okay.
okay.
So similarly, I mean, you guys can take other example. These are conversion. These were non-conversion examples. Okay. Now this is the conversion example. One thing, common mistake that CFA student makes over here. What is the current market price of a 240-day T-bill with a BDY of 5%? If this be the situation, what is the common mistake that many make is when you have solved the BDY sum, I mean, the answer that you got was in 0.1067 format. If you solve this, you will not get directly 10.67%. You will get it as this format, right? And then you would have converted it into an equivalent percentage, right?
Right.
If you solve this
Right.
equation, you will not directly get 10.67. You will get 0.1067, which you then multiply by 100, then you convert it into percentage, then you get 10.67, correct? Now here, when you are asked to calculate the BDY, you are given BDY and you are asked to calculate the current market price. In that situation also, you have to be very sure of that you put in 0.05 and not 5. If you put a 5 over here, then you will not get the correct answer or present value. It's basically reverse calculation. So using this formula,
Okay.
you got this, but now I say that I have given you this, I have given you everything except for the current market price. Now calculate that. I'm just reversing the calculation. But then students make a common mistake by putting 5 over here. It is not 5, it is 0.05.
So we must be aware.
Sorry?
So we must be accurate with putting
You
how
have to be.
we.
That you have
Yeah.
to be.
Yeah. Yeah.
Now you have a bit of conversion examples, although we have already covered these conversion examples because the conversion is from EAY to MMY, means you are given HPY, now convert it into EAY or convert it into MMY, or you are given HPY, convert it into EAY, you are given EAY, convert it into BY. All these things are already taken care of because we have covered the frequency of compounding. So the above what we did was we converted annual into semi-annual, annual into quarterly, annual rate into equivalent monthly rate. We all did that. Then we took a second example. We converted semi-annual into annual, semi-annual into quarterly, semi-annual into monthly. We did that as well. So these are those examples. Okay, similar examples. So that will not create an issue. Using the above formulas, you can easily solve it. Is it fine? Above we have already taken care of it when we solved the conversion examples of semi-annual to annual, semi-annual to quarterly, or annual to semi-annual, quarterly, monthly. We already did that, so you won't face any issue or challenge in doing these things. Only the nomenclature has changed. They have put a tag EAY. That means nothing but anything which is percentage per annum compounded annually. They have put a BY, nothing. It is percentage per annum compounded semi-annually. So in that way, it is designed. Okay,
Okay.
moving ahead then. Similarly, these are the examples. That's fine. Lastly, it is continuous compounding. So what is continuous compounding? Basically, it is, see, it is nothing new. When you keep on reducing the compounding frequency. Okay, if I give you an option, 10% you can earn 10% per annum compounded annually, or 10% per annum compounded annually. What will you prefer? You are given two options: 10% per annum compounded annually, 10% per annum compounded semi-annually. Which one will you prefer?
Semi-annually,
Why?
because it as a time value of money is I can get it shorter than annually.
And you get higher
Maybe.
interest because semi-annual compounding
Yes.
happens.
Yeah.
In that fashion, if I add an option of quarterly, which one will you go for? 10% per annum compounded quarterly, then
Quarterly.
quarterly, monthly,
Yeah.
daily,
Yeah.
hourly, every minute, every
Every second.
this every second is called continuous compounding. Continuous compounding. Continuous compounding means every second compounding. Compounding is happening every second. Since the frequency from here it was 1, we go to 2, then we got to 4, then we got to 12, then we got to 365, then we got to 365 into 24, then we hours number, then we got to 365 into 24 into 60. But this becomes so huge that we have to use a logarithmic formula, that is A is equals to, A means future value, is equals to P means present value, e to the power I into n. This is not a new formula. This is very much similar to Fv is equals to Pv 1 plus I to the power n. But since the frequency has increased so much, then we have to bring into a logarithmic formula, and that is why we have to put an e over here and e to the power I into n. This formula is continuous compounding formula. You can reframe or rephrase it as Fv is equals to Pv e to the power I into n. It doesn't change the meaning. It is same.
Okay.
Okay. Now
A
Yeah.
represents what?
it represents continuous compounding. Every second compounding. Compounding is happening every second. In similar fashion, if I ask you to calculate PV, what you will do? You will do an FV divide e to the power I into n, correct? Right? And if I am to put it in a more structured format, then you will write it as PV is equals to FV e to the power minus I into n. Why minus came into picture? You should be able to think it. Minus I into n because it was in denominator. If I take it to numerator, then a minus sign has to be introduced, isn't it?
Yes.
Apologies if my language or writing is not clear. One second, let me rewrite it. If it is making confusion, just a second. E to the power minus I into n. This and this is same. We should recognize. that nothing has changed. I have just changed this denominator to a numerator, but nothing has changed. That's why I put a minus sign. Remember, since this is e, which is natural log, if e to the power anything is in plus, e to the power anything is in plus format, the resultant will always be greater than 1. That means it will be used to calculate future value. When you have a resultant which is greater than 1, that is 1.01 or 1.02 or 1.05, and if you multiply it with number, it takes you forward, it increases the value, right? And the higher value stands at future. Okay, but if I put a minus sign as e to the power minus anything, any number, then it will always result in a value less than 1, and less than 1 value is always used to calculate PV, because you are reducing the amount or you are pulling it backwards. Are we clear with this? I'm trying to say
clear.
that
Yes.
if you are given a situation in exam where you are given 10% per annum compounded continuously, now you know how to deal with other types of compounding, annually, semi-annually, quarterly and everything. But if they write compounded continuously and they ask you to calculate future value, then it will always be e to the power plus. And if they ask you to calculate present value, then it will be a e to the power minus. Because a e to the power plus will generate a factor which is greater than 1. That means it will increase the value. And e to the power minus will generate a factor that is lower than 1. That means it will decrease the value.
Okay.
Okay.
Okay. We have an example over here. So can you guys try for example 1?